Good morning, good afternoon, and good evening, ladies and gentlemen. I know we have quite the global audience today from various parts of the world. First of all, I'd like to thank everyone for taking the time out of their busy schedules, especially as we get towards the latter half of the year, to join our economic update, the last one for the year for our series in 2020. Today, we'll be discussing a number of tailwinds that the economy and markets have lined up for the year ahead, as well as how this current year has unraveled. So you may know me, I'm Cam, or Cameljit, the lead financial analyst here at Dunhill Financial. Just a bit of housekeeping rules and a brief rundown of the format before we get started with this webinar. So everyone will be put on mute as soon as we begin the presentation. But again, please feel free to ask any questions throughout the presentation in the chat section. Again, we will also be having a dedicated Q&A section towards the end to answer any questions you might have. Just before we start, a few disclaimers to go through here for compliance purposes, so just bear with me. Dunhill Financial is a registered investment advisor. Any information presented here is for educational purposes only. Again, this isn't a sale or solicitation for any specific advice. Investments may involve risk and unless otherwise stated are not guaranteed, so please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any of these strategies. With that out of the way, I shall hand it off to Brian.
Thank you, Cam, and Merry Christmas and Happy New Year to everyone. I'm so glad to have a nice group of people joining me as we go through all of our New Year's resolutions in preparation for 2021. And naturally, the number one New Year's resolution is finding better ways to manage your finances. So I thank you for joining me and making 2021 an epic year. We know we want to get to that. Now, when I lived in San Francisco, there was an expression that essentially there was more churches per capita in San Francisco than any other city in the world. And they always said that they had more churches than everybody else because they needed them. So the first question that I'm going to pose towards Cam is there a correlation with us needing more real Christmas trees and fake Christmas trees right here as we get nearer towards 2021, or is that just an association to something else? We've got a fun afternoon lined up. We've got three main takeaways that we want you to get out of this. The first one is that the markets come back. We should have independence of what we're planning for financially with what's going on in the world for the short term. And if we separate those two, we'll do quite well. The second thing I want you to take away from this whole presentation is that this time isn't different. We've gone through all of these cycles many times before, and all the foreshadowing that we're using is using those as examples of how we should be taking on this crisis and hopefully a recovery in near term. And then finally, what our plan is and how we're going to be working with you in reshaping the portfolios in 2021. As they say, the best time to fix your roof is when it's sunny outside. And I can't think of any sunnier time in the general economy than when Brexit's finalized, once vaccines are, now that vaccines are in place, and once we've got a little bit different leadership in certain countries. So that's what we're going to try to go through today. And we'll start with an old bestseller. Most of you have probably read The 7 Habits of Highly Effective People. And one of the most interesting parts is that you're trying to get to a concept of first getting towards independence. The first 3 habits are all towards getting to independence, which is very important because that allows you to separate yourself from things that you cannot control. And 2020 is a perfect example of a year that we could not control our surroundings. I don't think I have to remind you of every single one of the different aspects. After the presentation, Cam will be sending out this exact slide and all the other slides. So I'm actually going to just concentrate on the fun down at the bottom because we are just a couple days away from New Year's. while 56% of Americans toast their champagne or their sparkling wine or whatever it might be right at midnight. I think there's a couple other traditions that are a little bit more fun. The Danes throw their dishes in front of your door, all your friends' doors. The Spanish eat 12 grapes right at midnight for all their wishes of the new year. And the Germans watch a funny English film that's called Dinner for One as many times as they can during the day, and somehow some of them turn it into a drinking game. So I'd love to hear some of you, if you have good traditions from your own countries, of what we can do to put 2020 behind us. But I think we can all agree that it was a tough year for many of these different aspects. The biggest, naturally, is the pandemic. I don't have to remind you of that. And COVID has taken over everything that's going on. Thankfully, we've been wrong about a few things. We predicted that emerging markets would be affected in a similar way as they were 100 years ago during the Spanish flu. And that led us to selling out of positions in India and some other emerging markets, which most of the rest of the market did the same. So they performed as we expected them to, but thankfully, many emerging markets are not the hardest hit. Well, in learning for the next time around, this is most likely because of the demographics of this pandemic, where the Spanish flu affected people of all ages, significantly troops. This pandemic has really hit the vulnerable and the old much harder than anybody else. So we were glad to be wrong about that. But as we see from Avish's chart, which we've shown you many a times before, we have certain economies, certain places that have fallen off the cliff when it comes to number of cases by controlling it wisely. We've seen other countries, mostly ones that are driven by populist leaders. You've got your Bolsonaro, you've got your Putins, you've got Johnson, Modi, Trump. We see them far out on the chart not being able to control this pandemic at all. But hopefully it will be controlled now that we have a vaccine. Now, this is where we were right in 2020 that healthcare stocks were not the place to dump our money. We're using the example of Pfizer because they came out with the first vaccine, or were approved for the first vaccine. And so what you can see here is that right after the vaccine was announced, the stock spiked. But ever since, it's retracted right back to where it was pre-corona and most of the time during corona. So while there was an opportunity, if you were to buy in back in March when the market crashed, there was a lot of other places that were much more attractive. And so this is where we're going to stick with the learnings that in pandemics, healthcare stocks, pharmaceuticals are the companies that are going to save us, but most of the money that went into them was government money and government guarantees. There were 200 companies that were trying to come up with vaccines. A couple of them have come up with vaccines, but they're not going to be hugely profitable. And that's why we stayed away from that very rich trade. Now, does the vaccine mean that we're out of any of these problems, that we just have to wait a due course of time? Not exactly, because the first segment is that most of these vaccines have been purchased by the developing world. And while that's great for our home countries, we won't be back to normal. We won't get our supply chains back to normal until the emerging markets are also going through getting vaccinated. So we're probably not fully back to normal until 2022 at the earliest. Hopefully by this summer, we'll no longer be in this lockdown culture. Hopefully by the end of the year, we'll be able to travel a little bit between travel blocks, but supply chains getting fully back to normal, probably not looking like it will be the case until 2022. Now, we started the year talking about V-shaped recoveries, W recoveries, bathtubs, swooshes, everything you could think of, which basically said that the market would go down and then it would come back, with the period of time being the most important variable that we didn't know about. what we have seen has been far from that. We've been describing it as a K recovery, which, think of the shape of a K. Everybody went down at first. Essentially, the rich got richer and the poor got poorer. Now we'll start with the general economy, because everybody in the economy essentially in certain ways got a little bit poorer, but certain people got hit harder than others. And it's no surprise when we look on the left-hand side, which sectors got hurt the hardest: hospitality, leisure, education, health services, etc. Now, the problem is that these companies are much more heavily owned by individuals or small groups. They're private companies instead of being public companies. There's many of stats out there that are predicting that 2/3 of restaurants will disappear in the next year, which is a sad, sad thought, because, well, we're American. A lot of us are American, so we think with our bellies. That being said, this chart shows us what stocks did the best this last year in the stock market. And it's no surprise that the technology stocks, which are the biggest components of the overall index, have actually performed the best. So you see Amazon in there as a big bubble. You see Apple, you see Microsoft, you see Google. So these are those names that anybody that's in the investment world has done quite well, and that's the upside of the K, versus the general economy is the downside of the K. That's not what we're rooting for. That's just the reality of it. And it happens in a lot of these recoveries when it comes down to big shocks into the financial system. Now, we can't talk about how the recovery is going to happen until we get to employment. And more or less, what we should be concentrating on when it comes to employment is that these charts and everything else that comes down to it aren't worth the paper they're printed on, or the computers that, well, computers are worth more than paper. So you know what I'm saying. For the younger folks, I need to find a different expression for this. But essentially, we have a couple components that have shifted the view on employment in big ways. The first one is the baby boomer generation. We've spent a decade where 4 to 5% of people in developed countries have gone from being part of the working crowd to the retired crowd. Now, this is significant because our economies work on money multiplier effects and the movement of money. And if that shrinks because more people are leaving that semblance, the unemployment rate isn't really going down. What's ending up happening is that a higher percentage of people are taking from the government instead of putting into the government. The second factor that we really should take into account is that the gig economy is really taking over the employment picture. And there's a lot of predictions that we might get up to 1/3 of the global employment being based on gig work. Most gig work is not represented fully in employment numbers, and that's impacting us even faster here during the pandemic. The last portion is probably the most important portion of why I don't believe the second side of this chart, which is that most countries have put together more generous schemes. Here in the UK, we have a furlough scheme. There's about 3 million people that are furloughed. So they're still being paid, but by the government instead of their companies, and therefore they're not considered unemployed. Whether these people will go back to work or not after the crisis is over is the true question. And that's to where these charts are not working for us on being a good leading indicator to where the market will go. Now, we can't be 2 days away from full and final Brexit without actually discussing it in big ways. And I think this shows so significantly how things have worked with GDP and with Brexit and coronavirus. Now, the main factor is that the UK has this opportunity to be able to blend the two into one, and nobody's talking about how much of the GDP loss was because of Brexit and how much of it was because of coronavirus. It's impossible to unravel the two, which gave the UK a great negotiating tool when it came to negotiating with Europe to leave right here at the end of the year. Now, it's also led to a 70+% drop in GDP quarter over quarter, which, to put that in perspective, means that essentially the UK is the worst performing developed country in the world. Even worse than all the Mediterranean states that did so badly during the financial crisis. This could come out to be an opportunity in the long term. There could be opportunities at buying cheap pounds. There could be opportunities in some of these British companies and for them to get ongoing expansion. That being said, we think it's still a little early to make this prediction because we still don't know what most of the outcomes will be from this Brexit Accord. Let's be honest, we have 1,200 pages, of which around page 900, they're talking about technologies from the 1990s that nobody uses any longer. And therefore, most of the Brexit Accords are still debatable of how they're going to be interpreted. We don't even know exactly how financial services will work going into 2021. Luckily, our company is licensed in both Europe and the United Kingdom, so we don't have to worry about it. But many other companies are not, and they're not prepared. So this is that ongoing story that might be an opportunity, but we're not ready to jump in there just yet. Now, where does the problem come about? Well, same as during the financial crisis, everything's coming from lending. The government is taking on and lending a lot of money on their balance sheet. Just to put it in perspective, we've seen the US government take on $8 trillion onto their balance sheets just in this 1 year. And from 2008 till this year, they took on $13 trillion. So the size of their balance sheet has increased significantly. And this is something that makes us have to consider what's going to affect on currencies, especially the US dollar. Oh, sorry, I went a little bit too fast. So with that, we have made some tweaks to our portfolios in the last year. We will be making some more. Now, these tweaks don't take into account the entire portfolio. As you know, we like to have a core of positions in the middle of our portfolio that are for the long term, that we rebalance annually. But we have between 15 and 20% of our portfolio that goes into what are considered satellite positions or shorter term opportunities. Isa and Cam put together a wonderful video describing this that you can find on our YouTube channel. And so I will let that speak for itself.
In 2007, Warren Buffett made a bet of $1 million that an index fund would outperform a collection of hedge funds over the course of 10 years. And of course, he won. With that said, the market often represents opportunities and risks that are hard to ignore. So how can I have my cake and eat it too?
What is core? The core of your portfolio is a bit like a tree trunk. Having a strong trunk will allow the tree to weather a number of storms and in turn continue to grow. This analogy does not only apply to trees in the forest, but can also be applied to your portfolios. A well-diversified portfolio will have a number of strong core positions that act as the trunk of the portfolio.
What are the satellites? Sometimes an opportunity in an individual stock, currency, or other investment presents itself, or even excluding a certain portion offers an opportunity in the marketplace. The key towards having good satellites is that they remain smaller positions of the overall portfolio, so that you don't lose your overall diversification. At Dunhill Financial, we keep all our aggregate satellite positions to under 20% of the portfolio at all times. And in normal times, we would prefer to have no satellites. I miss those normal times.
I think we all miss those normal times as well, Cam. So what did we do for your portfolios in 2020? Well, at the beginning of the year, back in March, you might have noticed that we sold out of all of our real estate positions. This essentially was because we didn't know which real estate positions would do well and which ones would do badly. We've had a year where some of the big real estate funds like M&G have actually locked up their assets and are not allowing people to take their money out. We've had probably about universally a 30% drop in real estate positions. So we were a little bit early on that trade, and we were very happy to be out early on that. We use those funds to mostly go into technology stocks, especially e-commerce and payment platforms. So we loved Amazon, we loved Shopify. We even had a brief stint with HelloFresh, which we struggled a little bit with trading it properly because of the volume. We continued adding on to some of our payment platforms, Visa, MasterCard, and PayPal, which I'll be talking a little bit more about PayPal later. We also, because of our nervousness of those currencies, like I was talking about, that huge balance sheet in the United States, and Europe and the UK are not excluded from that conversation, we started increasing our hedges towards big currency movements and potential inflation movements. Gold and silver being for currency movements, eggs and cow main being for those inflation movements. Now, everything until we get down to cow main had actually worked pretty well in all of our clients' favor. Cow main, since we still haven't seen any inflation, has not performed so well. And well, we're going to hope that that remains the case. We also increased some of our currency exposure. We started removing some of our overexposure that we've had for the last decade in the United States to an underexposure, trying to spread that out to a lot more emerging markets and a lot more currencies, including a few currencies that we hadn't used in a while in Australia and Canada, which have actually had a bump up because of commodity prices increasing.
I think just to interrupt there really quickly, Brian, and to add to Brian's point about hedges in gold and silver and such, and selling off real estate, we saw central bankers across the globe come in, at an unprecedented pace and size as well, with the stimulus packages and the various policies that they enacted. So they've kind of dampened the volatility and the fear in the equity markets per se, but then that's at the same time it's taken risk away from the equities and lumped that into currencies, which is why going into 2021 and this year as well particularly, currencies are our main focus, because that's where the bottlenecks are going to appear.
It's a great point. We never want to fight the Fed, but at the same time, whatever the Fed is doing in a big way, we're able to follow those trades, and that's where it affects those currency markets. So thank you for adding that, Kim. Now, what should we be expecting going forward in 2021? We all remember Mark Twain's famous quote, "History doesn't repeat itself, but it sure does rhyme." Cam, sorry, you even write it on the screen and I misquote it. Now, essentially, what we can follow are these trends of when the dollar goes up or the dollar goes down, how emerging markets and how non-US markets perform. And this is to where these are nice complex charts, and Cam will probably pop in and he'll explain them to you, that we can see a direct correlation, and therefore we want to actually go with the past sequences. I hear you chiming in there, Cam.
Yeah, I think just to add to Brian's point there, the consensus out there on the street, from many other institutions is we're going to see a weaker dollar going forward into next year. And, the next couple of years, the dollar's enjoyed upwards of 10 years of strength. And naturally currencies are cyclical and, they take 5 to 10 years to play out. This one has particularly taken a lot longer. So on the left-hand side, you'll see, the ratio of the S&P 500 versus the MSCI emerging markets. So essentially what this means is as the orange line is going down, emerging markets are outperforming the S&P 500. And that's how it was, during the earlier half of 2010 going into 2015. And then later on the right-hand side, we can see the orange line start to go up. And essentially that means the S&P 500 has been outperforming emerging markets due to the strength in the US dollar. Now, naturally, what we're and a lot of other analysts are advocating for, or forecasting, I should say, is that we're going to see a repeat to a certain extent of what's happened in the left, where the S&P 500 and a lot of the US tech-heavy stocks take a bit of a breather, and we see a bit of a cyclical rotation out from certain US stocks and US equities and into the more battered down, less well-known names, in China, in emerging markets, Latin America, and so on and so forth.
That's impeccably said. When it comes to emerging markets, they do so well on a weak dollar because most of their debt is in dollar currency. So as the dollar goes down, the cost to repay their debts goes down. The greatness of a dollar-filled world. Now, earlier I said that we started to introduce some new positions in some of these countries that we'd given up on their currencies a couple of years ago when the commodity crisis hit. And now as we're seeing commodity prices start to improve, we're seeing the Canadian dollar and the Australian dollar actually doing quite well. So again, that plays towards buying outside of the United States. If commodities continue to rise and the dollar continues to fall, that's going to be hopefully not just a short-term trade, but a little bit of a movement for a period of time. Now, we've spent a long time talking about strategic allocation and how we want a certain portfolio and we want to just be diversified. But in interesting times like we're in, sometimes we have to make these tactical shifts. And this is to where first we'd like to say we're never going to go over that 20%. But even when we look at some of the best investors over the course of time, Warren Buffett, in this example, you can see he's made huge shifts in his cash positions, in his position in Coca-Cola, and in many other companies. Even more recently, once it catches up to how fast I speak, with his position in Apple. So he's gone from only consumer staples to getting large positions in cash. He's always been in the insurance business. That's what Berkshire Hathaway is. But he's changed and evolved over the course of time with what's going on. And that's why he's been able to net some of those great returns. So we don't want to be just too stuck on, I'll put 90% in the S&P 500 and 10% over into 10-year T-bills. 10-year T-bills are hardly yielding anything, and the S&P 500 is not going to be the only name in town now that we're looking at dollar weakness.
I think to add to that as well, Brian, this chart only goes up to June, so it doesn't include Warren Buffett's foray into Japan, which was towards the latter half of 2020. And again, it shows that people, investors such as Warren Buffett as well, are looking outside of the US, for growth, because everyone sees this weakening dollar going forward, and typically emerging markets bode quite well with a weakening dollar regime.
Great point. We've never seen Buffett take such a big position internationally, so it speaks to the big movement outside of the US. Now, we are starting to have a little bit of a recovery. We're on all-time highs on the stock market, so naturally the stock market is gearing towards a recovery. We have not started to shift too much of our portfolio into the recovery trades, because naturally, as we've seen from the last week, we're a long way away from being fully vaccinated. As we were talking about earlier, we're not talking about getting fully back to normal until 2022. We've started making trades in the first bin, green energy industry. Now, this is typically an energy trade, because when oil stocks cratered, essentially a lot of people are trying to buy these on the bottom, your BPs, your Chevrons, et cetera, et cetera. Now, we're not buying into that for two reasons. First of all, we'd like to be a little bit more socially responsible than that, and try to reflect on companies that are trying to build a better world. But secondly, because conventional wisdom is that we can't fight the governments, and the governments are all investing in the green energy industry, all in different ways. Nearly half of Biden's infrastructure plan is going into energy infrastructure in a green way. So we've started buying into these, and they were some of the best performers last year, and we believe that will continue. So that's the only one of the four sectors that we feel will be in the recovery trade that we've started to dip into. But we're actually starting to have conversations about real estate evaluations and where they could potentially hit bottom. We've seen some of these REITs, real estate investment trusts, drop 30 to 40%, and many others that have dropped even further. So at a point, a building is actually worth something, no matter how bad the general economy is. And we're trying to manage that. Some of the big hotel stocks, the cruise lines, et cetera, performed way better than Pfizer did on the first day of the vaccine announcement. That being said, there's still net losers in this whole process until we get closer to normal. So we're still on the sidelines when it comes down to it. Mm. But we're just trying to make sure that we have our action plan and that we're analyzing things for when we're ready to get into the market. Cam, exactly. You have something to add there?
Naturally. And like Brian said, with a lot of these reopening trades, or, the trades when we're on a fully recovered path, a lot of what we're seeing in the markets right now is front running that potential recovery phase. But at the same time, when we're dealing with people's retirements and such, we don't want to be too ahead of the curve, because we don't mind, losing some of those gains. But at the end of the day, having certainty, because, if you look at a stock like Carnival Cruise Lines, sure, they have a lot of capital, in their war chest to survive if this does drag out for a lot longer. But at the same time, there's a lot of companies out there that don't have such impeccable balance sheets, that don't have access to the liquidity that they need to keep running without any revenue generation. So, at the end of the day, it becomes more of a speculative market, or trying to take a gamble on which of these companies will make it out to the other side. So that's why we're much more, inclined to take a backseat approach and see how this plays out. And then naturally, once we have a more clearer indication of who the real winners are and which of the industries are actually going to make it out, in one piece and then some, we'll naturally, make those shifts as and when the time comes.
Perfect. Well, we have to tackle the elephant in the room. And the elephant in the room is valuations of the overall stock market. Now, again, a little bit more complex of a chart than what we'd like to show, although I've shown this many a times before. Instead of just a price to earnings chart, we're using the Shiller PE ratio. Now, the Shiller PE ratio essentially takes the last 10 years of PE, so price to earnings. So we take the stock price, we divide it by how much they're earning per share, and get the average valuation there. And then we average it out over 10 years. Now, this just flattens out some of those anomalies and gives us a little bit more of a longer term trend. Now, what you'll notice is that, yes, we're edging up higher here at 33, but we're nowhere close to where we were when the dot-com crisis hit back in 2000. So the first portion is that. The second portion is that we have many companies that are the biggest parts of the S&P 500 that were not very profitable 10 years ago, but are hugely profitable today. Think of Amazon. Didn't start making a profit until about a year and a half ago. When you look at Apple, it was nowhere close to the size that it is today 10 years ago. So when we look at these things, they shift a little bit slower than they could, which is a good thing, but at the same time, it can misrepresent some of the numbers. The other thing is, you'll notice between 2008 till today, you have a direct correlation of that increasing as interest rates have gone down. And Robert Shiller, the famed economist who put this out, has actually revamped to actually correlate to that, to where he is stating that he feels that the markets are undervalued, not overvalued. So this is a great concept just based on the comparison of bonds versus stocks, that stocks are not really overvalued at this point in time. On top of that, even though earnings suffered this year, except for the tech sector, which makes up the biggest portion of the S&P 500, at 23% just for the FANGs, Facebook, Apple, Amazon, Netflix, and Google. But when you think the breakdown of the S&P 500, that still leaves that 77%, which are all those staple names that we know and are expected to grow by 22% for their revenues in 2021. So a lot of that will be caught up in the next year. So when it comes to the values of stocks, of the stock market overall, are we paying close attention to it? Are we listening to the news? Yes, absolutely. Are we afraid of it? Absolutely not, because the alternative is to be sitting in a cash position, which is not attractive, or a bond, which might be even less attractive depending on the country, because it might be at a negative yield. But even a Chinese 10-year bond is only yielding 3%. So there's not many attractive bonds out there. There's some attractive currencies for diversification. That leaves us with essentially one piece in the stock market. There's been a lot of talk on IPOs. Now, these have been entertaining to pick up the Financial Times in the morning and read all about them, but you haven't heard us talking about them. The main reason is that valuations for many of these companies are beyond attractive for us to be buying into at this point in time for what could be concepts, and some of them could be true disruptors. We'd expect more and more of these to come online in 2021 as valuations are quite high, and naturally the original investors would love to sell into a richer market rather than a poorer market. So you'll see these coming out, but instead of looking at Airbnb, we'd prefer looking at a company like Booking. We'd prefer the staples that we know exactly how they work, how their management are going through things, and how we should be properly valuing them. Airbnb is that perfect example where they're floating at a time in which we have no idea how this is going to reflect upon their business. This graph, you can see their revenues have been decimated when nobody can really travel. And once people can travel, we don't know if they're going to feel comfortable staying in somebody else's house versus staying in a Marriott or a Sheraton, where you know what the cleaning status is going to be in staying there. So there's risk inherent in the IPOs that are out there that we don't really feel comfortable with. The other big talking point was Tesla. December 21st, it came IPO. It joined the S&P 500, and even more so, as we have the socially responsible index in our portfolio, it became one of the big positions in the S&P 500 and the KLD 400, bigger in the KLD 400 than the S&P 500. Now, while this is exciting because we're excited that electric cars can take over the world, the valuations are a little disjointed compared to all of the other car companies combined. How I would factor it, which I know Cam has a different way of viewing it, so he might jump in here, but how I view Tesla is that they're already graded as if they're going to build the self-driving car, not just the electric car. And yet there's a lot of other big players that are trying to come up with the best self-driving car. And we're probably still a good decade or two away from fully autonomous cars. Therefore, a lot more players will come into that. So that being said, this is now part of our universe automatically, but we're not counting on it being the driver of performance, but we'd be happy to be wrong.
Additionally, just to add to that, a lot of these names, as in the previous slide with the IPOs and with Tesla, these stocks, they come out, they don't really have a whole lot of strong fundamentals, although, a lot of people can argue what that exact definition is. But, they're very much a story-driven stock with, great leaders at the helm driving it. And again, a lot of these names like Tesla and some of the IPOs that we're seeing, they're very much in the disruptive innovation category. So a lot of times, investors have a hard time putting exact valuation metrics on them because, using, traditional metrics that you typically use to value your more, value-oriented names, it's a lot harder to apply those to some of these more disruptive innovators.
And those stories can be great or they can be horrible. We've seen the Robin Hoods trade a lot of these stocks, and we know Warren Buffett's old tale is always fight the little guys, do the opposite, and you'll do well, which is called the odd lots theory. Now, everybody's hunting for yield, and what we don't want to do is we don't want to get too exotic when it comes to yield. We prefer to look at the stock market and dividend producing stocks to produce that yield, and getting more diversification for currencies. But the other side of things is that we have a direct correlation. You can see gold prices, when they're doing badly, that's when yields are going up. Whereas when they're doing well, that's when yields are going down. This is why I had to go off a 20-year tradition of saying the same thing, that gold is a waste of money, to last summer, well, not this past August, but the August before, saying there is a place in our portfolio for gold. Now, we would expect that to continue as those yields stay low. When yields start to increase, which we would hope would happen in the next couple of years, that is when we'd be looking at offloading that gold position and trying to take off that hedge for the risk of those currencies moving. The last concept that we've been getting a lot of phone calls about are cryptocurrencies and Bitcoin. And we've always shied away from these. Mostly, we love the technology behind them, but mostly because it's so easy for a government to push them out at given times. Now, that's not to say that we don't like the concept of having a currency that can't be manipulated. As an economist, I love the thought of the government not being able to print more, so therefore you know exactly what you own. But in looking at past traditions, as we are in this segment, based on the Mark Twain quote, we'll stay on a San Francisco theme. We'll talk about Levi Strauss. In 1849, tens of thousands of people went out west to mine for gold. And I would buy that nobody on this phone call could probably name one gold miner at the time. But Levi Strauss went out there to go ahead and sell products for those gold miners, most notably jeans. And we still wear those jeans. We still know him, and the gold rush made him rich. So while we're not saying that Bitcoin or any of these other couple of thousands of cryptocurrencies are going to do well or do horribly or anything else, we've chosen to play it in a little bit different way. This is Cam's way of telling you that cryptocurrencies are a little bit of a roller coaster. we've started to actually purchase more into companies that are platforms for people to buy cryptocurrencies, PayPal and Square. Now, both of these platforms, you can go on them and you can buy and sell any of those different cryptocurrencies. So they make money when it goes up, they make money when it goes down, and we don't have to worry about whether it's a bubble that's just waiting to be burst or whether it's the next big thing, because we're part of the market, but not just betting all our money that we're going to find gold. You can see Square has done extremely well in the past year. Same thing with PayPal. We've had PayPal in the portfolio for a lot longer than just this last year. It's just been the increase in the last year. Some of the best performing companies out there. And that gets us to probably the most controversial topic as of late, which is China. Now, China has been a wonderful opportunity because since August, I think it was August, Cam will correct me if I'm wrong on that, we've seen the renminbi actually increasing compared to the dollar. This is the exact opposite of Donald Trump's rhetoric that China is always just printing money to go ahead and take advantage of America and the rest of the world. That was the case for a very long period of time. That was the rhetoric so that they could distribute more manufacturing items at a very, very cheap price. But now it's reversed. A couple reasons why it's reversed. Well, first of all, they've recovered the fastest from coronavirus. Second of all, essentially, they have a vibrant group of technology stocks in the BATS that have built a bigger infrastructure of venture capital in China than what we have in Europe and the United States combined. So we have more unicorns in China than we have in the US and Europe combined, which says a lot about the potential growth out there. So we have an increase in currency, we have a tech sector, which technology stocks have been doing the best no matter what country they're in, that's bigger than any place else. And they are pushing through for influence through the Silk Road Initiative that we talked about on the last economic update. That being said, the big news is that they could be delisted from the New York Stock Exchange and all US indexes. And the main reason why is because it's illegal for a Chinese company to disclose their balance sheet or any of their other financials. And yet, at the same time, it's illegal in the United States for a company not to divulge what they're doing and to actually let people look into that. So conflicting sides of things. Now, the delisting process will take about 3 years. So these Chinese companies will have 3 years to conform, otherwise they'll be thrown off the indexes. What will happen with the indexes is essentially institutional investors will be able to buy and sell them, but individuals would not. So this is to where we've started to change how we're investing in them. We're investing more through ETFs or funds instead of buying direct Alibaba stock or Baidu stock and the likes, which is a different form of opportunity. We're not buying China as a whole. We're still just concentrating on their tech sector. It's hard enough to interpret a bank from the West. I don't want to start trying to interpret a bank from the East when they don't divulge any of their numbers. Now, there's also been some talk, which was a pre-submitted question, thank you, Hugh, on whether we as fiduciaries can actually promote a stock when we don't know the underlying values. So I wanted to talk to you why the other reason why we really like technology stocks in China. When we look at a company like Alibaba, we can compare it very easily to its counterpart in America in Amazon. And we can take a historic multiple of what its price is versus what Amazon's price has been over the course of years. We know the size of the market. We know how much e-commerce penetration there is in China, which is much higher than the United States or any place else in the world. But yet they still have plenty of growth trajectory. So therefore, by taking that historical multiple, we know if it's less than 50% of the value, the market cap value of Amazon, it's underpriced. If it's over, then it's overpriced. And that's how we're able to use those metrics to find a good way to value these types of companies.
I think speaking of, if you don't mind just going back a slide, Brian, speaking of Alibaba and a lot of these e-commerce giants over in China, a lot of other comparisons are, because we can't see their direct balance sheets and such and their financials, you'll have a lot of our analysts, trying to track the deliveries and such. So the data on the data, so to speak. So that's why we know, Alibaba is half the market cap of Amazon. So that's your discount there due to it being a Chinese stock. But at the same time, that there is some data out there that supports, their sales figures and such. So we can draw those comparisons and parallels and come up with some sort of justification on whether they are legitimate companies and to what extent.
Exactly. So what does this mean for us in 2021? We talked about what we did in 2020. What are big changes going to be going forward? Well, first of all, we're going to continue increasing our exposure to emerging markets. We discussed that when the US dollar goes down, because most emerging markets debt is in dollar terms, the cost of financing that debt goes down, making those companies much more profitable. Add to that those were some of the hardest hit companies at the beginning of the year. Essentially, that offers us a great opportunity for growth in two ways. We're going to decrease our exposure to the US bond markets. It's no longer the safe currency. It's no longer a great safe haven with the dollar going down and yet quite low yields on most fixed income over there. It's not that attractive of a purchase in any way, shape, or form. We'll continue to buy in the tech sector. We'll probably expand that universe. Some of you have heard us talking about companies like Allegra or Mercado Libre. Mercado Libre and Allegra are both in the same type of business, similar to Alibaba and Amazon. Allegra is the Polish and European version. Mercado Libre is Argentinian and basically goes all the way down through through South America. Now, if you don't have Mercado Libre in your portfolio, you don't have to fear. PayPal is one of their biggest investors. So as Mercado Libre does well, PayPal will do well. And the more you buy on e-commerce, the more you use those e-payment tools. And that is why PayPal is investing in a large way in there. You're also going to see us starting to increase our exposure to small caps. And small caps essentially were some of the hardest hit last year. So for the same reason as emerging markets, they have a lot of debt, but essentially they're going to be the quickest to recover as we get back to normal because they have the most debt. So these are our plans for the early part of the year. Going back to our old slide on where we'll go into the recovery, we will be looking at more socially responsible companies, especially in the energy sector, real estate investment trusts, and the leisure and hospitality universe, but we're just not ready to make big purchases in there. Coming back to the 7 habits of highly effective people. Essentially, we want to make sure that no matter what we're doing, we always have the end in mind. If we have the end in mind of why we have these portfolios, why we're doing these types of things, how much we need in retirement, we don't have to worry about these blips like what we had in March, and we can actually think about that long-term perspective. So if you don't feel comfortable with where your portfolio is, if you don't feel comfortable with the movements in the portfolio, please be in contact with us as soon as possible. And for everybody else, we hope to be talking to you very shortly. With that is the presentation. So I'm going to bring back Cam so that we can introduce the Q&A.
Thank you. Yeah, as Brian said, that is the end of the presentation, and I hope our audience found some useful insights there, as well as people listening back to the recording, going into our vision for 2021 and certain glimpses of what the market has to offer. So we'll be opening up to the Q&A section. Again, please feel free to post any questions you might have in the chat below. Please note we won't be able to answer any specific sensitive questions in relation to your portfolios and such, but please feel free to email them and we'll be happy to have a look at that. I think we'll give it a few minutes for people to type out their questions in case they have any.
It looks like we have a few in the chat, Cam.
Okay, I think we've got one from Barbara, posted earlier on. Okay, let's have a look. Okay, so with the gig economy being a great point, business and economic development focus attention. Is there less need for brick and mortar, or will people be ready to stop working from home and need better placemaking? So I guess this goes back into the whole, the office environment when we do come out of lockdown in next year. Hopefully, are people willing to go back to the offices, and those businesses that rely on those people coming into the office, those cafes, your restaurants, your Starbucks and such, what's the trend there?
Well, there's been a few reports on this, and most of it's speculation, but I think the easiest way to mark that is how many people want to work from home versus would rather go to the office. And the last statistic that I heard on that was it's around 20%. While I enjoy working from home, I love going into the office to be able to associate with Cam and Isa and everybody else. But there's other people that essentially they'd prefer to work from home because it makes life a lot easier. So if that's around 20%, whereas pre-crisis we were around 11% of people actually working from home, we would expect some disruption, but not a calamity, not a destruction of our major cities like New York or London. It will probably help shift some more businesses out of city centers to cheaper real estate, but these are trends that have already been happening for 10, 20, 30 years. Think of all the rent that was going on, the over expenditures out in San Francisco and the Bay Area. They've been moving center points outside of San Francisco for years. This is going to be able to give them the excuse to do it a little quicker. So I tend to think that yes, that will progress, but it won't be disastrous.
We've got another question from Kathleen. So the question is, since there are many human rights and censorship concerns regarding China, how does that fit in with investing in Chinese tech, especially in regards to our focus on socially responsible investing?
That is, they're not holding back any punches today, are they? Thanks for the question, Kathleen. That is a great question, and it is one of those questions that's very hard to answer, because naturally the tech companies in China are used for certain encroachments on what we would view as our civil rights and the such. They also lead to a lot of growth in emerging markets outside of just China, et cetera, i.e. does the good outweigh the bad? It depends which good we're talking about and which bads we're talking about. So they're not perfect, but nor are the FANGs, nor are any other of the companies that we're talking about in those types of universes. They're disruptors, and that's what makes them attractive. And one of the things that I would point out is, and I know I've talked about this many times, we're 3 years into a 5-year initiative on social responsibility. And we're not trying to say that we're perfect when it comes to social responsibility. We're trying to better understand it. At the beginning of the year, many of you will remember when we took out our money out of real estate, we popped a lot of it into Amazon. And Amazon has done incredibly well. So we were ecstatic with this trade, but we were very happy with our clients coming back to us, and several of them saying, I don't want to own Amazon because of how they treat their employees. Now, that became something that I made a mistake on, because I view social responsibility as the environment first. And yet that's not a wrong interpretation of social responsibility, but it's also not the right interpretation. So Cam and Ease have put together a nice survey that we sent out to most of you, asking you for your views on social responsibility so that we could do a better job going forward. And to me, Kathleen, this is that exact place that we want more input from everyone on how they view social responsibility and what they would feel proud of having in their portfolio, so we can tailor their portfolios to them instead of just my views of how the world should behave.
I think with social responsibility as well, it's one of those questions where there is no wrong or right answer. You know, everyone has their own specific opinions, as Brian mentioned. His concern is more so on the environment. Other people might have, you know, human rights and such as a higher priority on their list. So again, it's that ongoing conversation rather than a straight black and white answer, so to speak. We've got another question from Hugh. What's your sense on the future for UPS and other shipping and delivery companies, Zoom and other online meeting venues, along with home delivery enterprises post-COVID-19?
Well, naturally, these are all companies that have done extremely well with the crisis, and we only expect the trends to continue in their favor. Now, UPS, to me, is part of delivery company. That's the front end of the company that we see, but in a big way, it's a logistics company. The best examples inside of UPS are that they actually run that hub to fix so many computers so they don't have to be sent to the hub and then out to the computer location. They're done just right there inside. And these are efficiencies that most companies go after, and that's a bigger portion of what those big delivery firms and logistic firms are after, instead of just, can I deliver a box from point A to point B? When it comes to Zoom and other online meeting venues, when you listen to their end of the year reviews, essentially they're all looking at ways to continue to build communities instead of just, oh, Dunhill Financial is doing a Zoom call and you're all joining it today. So if they can broach that in a bigger way, that's going to be very attractive. Now, that might be the way that they make more revenue, or it could be like how Salesforce bought Slack for a ridiculous amount of money. And all of a sudden, well, a highly valued company doesn't mind spending an extra, what was it, $27 billion for Slack?
I think something to that extent. I'll have to fact check those figures.
So essentially, there's a lot of cash and a lot of money that can go after these types of services that can be accretive and add to some of those big tech companies. And I would expect to see a slew of these takeovers to where they can actually do quite well going into 2021.
Mm-hmm. We've got a question from Rhonda. What investment opportunities do you see with the change in the US administration policies besides the green energy initiatives?
Well, naturally, the green energy initiative is the big one right now with the Biden administration. On the other side of things, there are going to be the negative ramifications of the tax cuts being repealed. So a lot of those are some of those negatives of why we feel that international exposure is going to be a little bit more advantageous to us at this point in time. So I don't see many other opportunities in the United States just because of Biden. I see it more of a move towards normalcy and a move towards recovery that Biden will be able to offer us, i.e. 4 years of boredom, which will be very welcomed.
And I think I'll take a slightly opposing view to Brian here. You know, we do know that there's upwards of $1 trillion, you know, going into the infrastructure packages, and obviously there's a lot of green clauses in there for some of them. But you know, names such as your cyclicals, your more value-oriented names, you know, they will tend to do well. But again, that's more of a story of going from the growth to value than it is a specific administration initiative. We've got, I believe this is the last question from Armilla. In the emerging markets, which ones do you believe are worth investing in? And then the examples are India, Brazil, and Mexico, etc. So what are your favorites in the emerging market space, Brian?
Well, John Authors had a great newsletter this morning. I don't know if you had a chance to read it, of which he reports out on the last day of the year, every year, the hindsight hedge fund, which naturally just looks at, if you would have invested in this on January 1st, you would have done the best. And naturally, if you would have invested in just about anything but in Brazilian real, you would have performed the best of anything that you could have done. So with a currency being the worst hit, they're not out of the woods right now. And I'm not saying that we've hit bottom, but once they do hit bottom, they're going to have the most room to move up in that way. Now, Mexico has already started their ascent, and so there are some opportunities there, but we have to remember that CEMEX is the biggest component of the Mexican exchange. So until we get a full global recovery, Mexico, the peso can do well, but we're not naturally going to get the best suit in there. India is still reeling from some of the problems that Modi had created at the beginning of the year, but has also started the recovery. We in our emerging markets, we really like China and Southeast Asia the most of all of those that you just mentioned. We know that they're already out of the woods. They're on that growth segment, and there are some great names that we've been going after and appreciating there.
I think to add to that as well, when we think of emerging markets, you have to realize that 50 to 60% of a lot of these major indices are composed of China or China/Hong Kong and Taiwan. So emerging market performance is very much driven by what China does, but at the same time, laggards such as India, Brazil, Mexico and such, they will contribute their fair share. But again, at this point, as Brian mentioned, it's more China and Southeast Asia that we're more optimistic on, especially going forward. Okay, I think that's that wraps up the Q&A section here, I don't believe, unless we have any last minute questions. But again, I'd like to thank everyone here for attending our fourth and final economic update of the year, as we bid 2020 farewell and hope the new year brings with it a sense of optimism as we step forward. If you have any other further questions, please feel free to get in touch with us. The relevant emails are listed up on your screens there. Or alternatively, you're always more than welcome to book an appointment with us in the new year. We will be sending out follow-up emails with the recorded webinar along with the PDFs for the PowerPoint, so you can review them in your own time. Last but not least, we'll also be sending out a short survey just to gather your feedback. So again, we've done 4 of these in our episodes of what drives markets. So we'd love to get your feedback on the previous ones we've done and what you'd like to see for 2021 going forward. Other than that, I think on behalf of the team here at Dunhill Financial, we'd like to wish you all a wonderful holiday season and a happy new year for 2021. Thank you.
Thank you, Cam, for putting this together, and thank you, everybody. We'll see you in the new year.
Take care then.